You find the right apartment, apply for a standard car loan, or advance to the final round of a job interview, only to have a three-digit number stop the process. You are locked out. This number has become a proxy for character. We are told a high score indicates financial responsibility, hard work, and a clear path towards a stable, middle-class life. Yet a growing number of people find themselves in a strange position. They have perfectly optimized their credit profiles and achieved elite scores, but their actual net worth remains near zero. They are highly rated, but they have no liquid capital. This gap exists because the metrics used to calculate a credit score, like credit utilization and payment history, measure your reliability as a borrower, not your ability to accumulate wealth. The system was never intended to track your success. In its original design, the credit score was a risk assessment tool. It was built to protect lending institutions by predicting the likelihood of a loan default, making it a defensive mechanism for banks rather than an offensive strategy for consumers. When you treat a bank's risk algorithm as a roadmap for your life, you prioritize the appearance of stability over the acquisition of assets. This focus traps individuals in a loop of maintaining debt just to keep a number high. The first stage of this loop is debt dependency. To prove to the system that you can handle money, you must borrow it. You are structurally required to maintain active credit lines, meaning you cannot participate in the modern economy without remaining a customer of the banking industry. This brings us to the second trap: invisible costs. A suboptimal score acts as a continuous tax on your basic needs. Higher interest rates on a car or a home mortgage can add hundreds of dollars to a monthly budget. Over decades, this premium drains capital that could have been used to fund a business or an education. This leads to the third trap: delayed wealth building. Every dollar paid in interest is a dollar that is transferred to a bank rather than being placed into your own investment account. The math is unforgiving. When your income is diverted to service the interest required by the credit algorithm, you lose the opportunity for that money to compound for your own benefit. For many, playing the credit game perfectly results in a lifetime of subsidized borrowing for the bank, while the individual's own net worth remains stagnant. Beyond the math is the fourth trap: the psychological burden. Monitoring a number that dictates your opportunities feels like carrying a crushing weight. Many people begin to see a score drop as a personal failure. Financial anxiety grows as self-worth becomes tied to a fluctuating corporate metric that changes based on factors outside of an individual's immediate control. This leads to the fifth trap: the illusion of control. There was a common belief that a perfect score guarantees financial safety, but this ignores the macroeconomic environment. Personal credit optimization is often powerless against structural economic challenges that operate on a global scale. High inflation, a lack of affordable housing, and stagnant wages exert more pressure on a household than a credit score can alleviate. In this visualization, even an 800-point badge is easily overwhelmed by these weights. A high score might help you get a loan for a house, but it does nothing to lower the market price of that house or increase the value of your paycheck. Obsessing over the score distracts from these larger economic realities. It offers the feeling of progress, while the structural floor continues to shift. The credit system is not a moral judge. It is an amoral, standardized tool used by lenders to calculate the cost of doing business with you. Once you understand this, the score becomes a utility. Its only purpose is to lower the cost of capital when you absolutely need to borrow. Wealthy individuals often shift their focus away from credit monitoring and toward the metrics that actually drive independence. Instead of a single speedometer gauge, they track a radar chart of three specific points: grown their income, acquiring compounding assets, and maintaining financial flexibility. By prioritizing income and assets, you build a cushion that makes you less dependent on the approval of a bank's algorithm. In a system increasingly governed by algorithms, the most effective strategy is to master the rules well enough to stop being controlled by them. Lasting independence is found by focusing on compounding assets that produce value regardless of a borrowing limit or a three-digit grade.